We're going to talk about major expense insurance. This is going to be a bit of a history lesson, if you will, on the beginnings of what we know today as our medical benefits plan. The very, very first attempts for this kind of coverage didn't happen until after the Great Depression in the 1930s. And they made a first attempt. They were called basic medical indemnity policies or programs. They were what we would call limited coverage. They did not cover much of anything. There were three different types. Many people would buy all three of them to at least get some amount of coverage, or you could buy whichever one you felt you wanted to purchase in order to get the coverage you were looking for. So the first type on the basic medical insurance is hospital expense. And that's pretty much all it paid. Think of it as just covering your room and board costs, your overnight costs of being in a hospital. Some of them picked up things like x-ray labs and maybe even operating room fees. But for the most part, the basic hospital insurance covered that room and board cost only while you were in a hospital. The second type of these policies is called medical expenses. Again, very limited, and they covered non-surgical services and your in-hospital visits from your physician. Some of them covered extra things. It just depended on what policy you bought. Things like medical benefits, emergency room, hospice care, home health care, things like that, but not all of them even went that far. Usually it was the basic non-surgical services and then the doctor's visits while you're in the hospital. The third type of these indemnity plans was surgical expenses. So they would have scheduled operations. Scheduled means they had a list of all the operations that could be performed with a dollar amount, and that's what the plan would pay. If your operation cost more, you would pay the difference. If the total was less, then the insurance company paid for all of it. They also provided what is called relative care. Another way they looked at it is they would look at your geographic area and basically figure out what is the average cost, that reasonable, usual, customary charge from doctors for a particular procedure, and they would use that average number, and that's what the policy would pay. A couple of things to remember about these three very simple products is there was no such thing as a deductible. That had not been created yet, and there was no such thing as coinsurance payments where you split the coverage with the insurance company paying some premium and the insured. Those did not exist at this time. All three of these policies paid from first dollar or $1 of your out-of-pocket expenses. So first attempt by private insurers to offer some type of medical health care. Major medical expense policies. This was a step up from those very simplistic hospital indemnity programs that first were developed in the late 1930s. Customers basically went back to the insurance providers, the private insurance companies, and said, we need more, we need better coverage, because it wasn't covering like your doctor visits and things like that. It had, very low limits, very restricted on what they covered. So the insurance companies kind of sharpened their pencils, if you will, and they came up with major medical insurance. It's called comprehensive coverage. When you see the word comprehensive, it means that it offers a broad range of features or items that it would cover. Much broader, certainly, than the original hospital indemnity plans. They offered as I said, the comprehensive coverage for hospital expenses. Also covered catastrophic medical expenses, those large ticket items like open heart surgery that can be very, very expensive. Some of that could be covered by these policies. They also offered benefits for long-term injury or illness. That was unheard of until these comprehensive policies came about. Certain policy features that they became very well known for. They had a blanket limit, which is like an overall limit, if you will. And then there's a lifetime per person limit. Now, sometimes if you had some huge medical expenses, like maybe organ transplants or something like that, you might reach your per person limit on the policy, and that meant then you would have no more coverage. So you had to be aware that there were limits. These were the first policies that used deductible, meaning out-of-pocket paid first by the insured, and then the coinsurance payment, which is a sharing of the remainder of the claim by the insurance company and the insured, usually expressed as percentages. For example, one of the most popular percentages still used today is an 80-20 plan. 80%, that first number, is what the insurance company pays of the remainder of the claim after you, the insured, have paid your deductible, your out-of-pocket. And then the second number, that 20%, that's the additional amount then of the claim that the insured picks up as well. So the insured has two parts of a claim with a major medical plan. They're going to have their deductible that they have to meet first, and then their portion of the coinsurance. On the 80-20 plan, for example, that would be 20% of the remainder of the claim. These major medical policies did have large benefit maximums, which was very kind of mind-boggling for the time, because those old original hospital indemnity plans had very low limits and very, very restricted, limited coverages. So this was kind of revolutionary in the history of medical health care.